to session 2.3, Transactions Impact on Ratios. This is where we bring it all together. Do you know how to make journal entries? Do you know how they impact different accounts? And what does that mean as far as ratio analysis? So let's get started. So today we're going to talk about transactions impact on ratios. So what you're doing is you're given some transactions, and so you'll need to think about what the debit and the credit are. So for example, paid rent on building, you know that's debit rent expense, which is an expense, and you're going to credit cash, maybe, which is a current asset. The expenses are going up, the current assets are going down. All right, so if we think about the current ratio is current assets over current liabilities. So if cash is decreasing, that means the numerator is getting smaller, and if the numerator gets smaller, the current ratio will get smaller. So if you pay for expenses, your current ratio will shrink. The profit margin, though, is different. It says that our expenses are increasing. Well, if our expenses increase, that means our net income is decreasing. So our profit margin, which is net income over revenue, if the numerator is getting smaller, then it too means that the profit margin will get smaller. Asset turnover, you remember, is looking at revenue over average total assets. And those are the assets at the beginning and the end of the year. Well, revenue is not impacted by this at all, but total assets shrink, don't they? So because cash is going down, total assets are going to go down, so the asset turnover is going to go up. Debt to equity, total liabilities over total shareholders' equity or total equity. Well, you're saying neither of these was impacting that, but oh wait, isn't net income closed at the end of every period into shareholders' equity? Oh yeah, so if net income goes down, that means shareholders' equity is also going to go down, which means that the denominator is getting smaller, which means the debt to equity ratio will go up. And finally, earnings per share, which we haven't talked about, is nothing more than net income over the number of shares that are outstanding. So it basically says how much of profits every year go to each or could be attributed to each share of stock. So net income, we said, is decreasing. So that would mean that my earnings per share will decrease. Well, that's kind of what we're going to do here. So first figure out what the entry is, then figure out what it does to each and every one of those ratios. All right, so we've done the first one. Second one, received in advance payment. That means debit cash, which is a current asset, so current assets are going up, for services to be rendered for the next 6 months. Well, that means I haven't earned it yet, so it goes in a current liability called unearned revenue. So current liabilities are going up. Well, if I'm doing a current ratio, current assets over current liabilities, if both the current asset and the current liability go up by the same amount, their proportionality changes and your current ratio will decrease. Isn't that exciting? Since we're just talking about current assets and current liabilities here, there is no impact on the profit margin. as far as asset turnover is concerned, because our total assets are going up, our total assets are larger in proportion to our revenue, so our asset turnover will decrease. As far as debt to equity, total liabilities are increasing, so because the numerator is getting larger, debt to equity will go up, and earnings per share has nothing to do with that because that entry is not about revenue or expense. Looking at the third one, paid salaries of employees. That means I debited salary expense, so our expenses are going up, our net income is going down, our shareholders' equity will go down, and credit cash, so current assets are decreasing. Well, if that's the case, my current assets are decreasing, so my current ratio will decrease. Because my net income is decreasing, my profit margin will decrease. Because my total assets are decreasing, cash is going down, my asset turnover will increase. Because my shareholders' equity is going down, my debt to equity will go up, and earnings per share, since my net income is going down, my earnings per share will go down. What about the next one? Bought a 3-year insurance policy and paid in full. That's where I debit prepaid insurance, which means current assets are going up, and current assets are also going to go down because I'm crediting cash. Thus, it has no impact on anything because I'm swapping one current asset for another. What about performed services for a client, receive part of the fee in cash, the remainder to be collected in 30 days? Well, that means I'm going to debit cash for the amount of cash I received. I'm going to debit accounts receivable for the remainder. Those are both current assets. They're both going up. Revenue is being credited because I've earned it. It's going up. So when I look at the current ratio, because my current assets are going up, my current ratio goes up. Net income to revenue, well, my revenue is increasing, so my denominator is getting larger, and so that means my profit margin will increase as well. Asset turnover, it depends on the numbers, so that's why it says it depends. Because it depends on the proportionality of how much of the current assets versus the revenue. When I look at debt to equity, because my revenue is going up, that means my shareholders' equity is going up. That means my denominator is getting larger, which means my debt to equity ratio will get smaller. And finally, earnings per share. Because revenue goes up, net income goes up, and my earnings per share goes up. The last one, purchased office equipment. We paid part in cash, and the balance was accounts payable. So there, my property, plant, and equipment is increasing, my current asset cash is decreasing, and my accounts payable or current liability is increasing. Because of that, my current ratio will decrease. Because of the proportionality of the current assets and the current liabilities that can change. Profit margin. Profit margin, it has no impact because I'm just dealing with current assets, property, plant, equipment, and current liabilities. Asset turnover. My total assets are going to go up, so that means my ratio, asset turnover, will go down. If I look at debt to equity, I see that my current liabilities are increasing, so my numerator is getting larger, so my debt to equity will increase. And earnings per share, since nothing has to do with the income statement, it has no impact. So that's some examples. Well, I know you had so much fun here. We need to do some more. Here's another one. So here's some more. So the first thing you're going to do is make the entries, and then you're going to look at the impact. So purchase large amounts of office supplies on credit. Current assets are going up. Current liabilities are going up. We've seen this pattern before, and this is how it would be impacted. The owners invested cash in the corporation and received stock. That means my current assets are going up, and my common stock and the number of shares of stock are increasing as well. So this is the pattern for that. If we make an adjusting entry for the portion of the insurance premium which has expired, that means we're moving it from an asset account into an expense account, where we debit insurance expense and we credit prepaid insurance. So our expenses are going up, which means our net income will go down and our shareholders' equity will go down, and my prepaid insurance will also decrease. The current assets will decrease. And the pattern is as follows. When we paid off the office supplies that we purchased earlier, that means I'm not getting new office supplies or using office supplies, but I'm paying the office supply bill, which is a debit to accounts payable and a credit to cash. So for that, notice the pattern. No impact on income statement ratios. Adjusting journal entries for depreciation. If you don't know this, you're dead. Debit depreciation expense. Expenses are increased. Credit accumulated depreciation, which is property, plant, equipment. So my total assets are going down. And this is the impact there. Oh, wrong line. So the next one is make adjusting entry for office supplies used during this period. That's a debit to the expense, a credit to the supplies, very similar to what we're doing here. And so this pattern is the same. And the last one, made an adjusting entry to recognize the portion of the fee received in advance that unearned revenue has been earned. So I'm going to debit the current liability unearned, and I'm going to credit the revenue because that will increase it. And here's the pattern there. So think about this, go back and review it, and enjoy.